studying your last two. I swim med when turned in. The staring down to mute. And can learn the pole that sunky died.
To understand why Canada has both eligible and non-eligible dividends, we first need to understand the principle of tax integration. Tax integration is one of the fundamental goals of the Canadian tax system. Its purpose is to ensure that income earned through a corporation is taxed approximately the same as income earned directly by an individual. Imagine a business earns a profit. That profit is first taxed at the corporate level. If the remaining after-tax profit is later distributed to the shareholder as a dividend, the shareholder also pays personal income tax on that dividend. At first glance, this may seem like the same income is being taxed twice. However, Canada's tax system is specifically designed to prevent excessive double taxation through the use of the dividend tax credit. Now consider two different corporations. The first is a large corporation that pays tax at the higher general corporate tax rate. Because more tax has already been paid by the corporation, the shareholder receives an eligible dividend, which comes with a larger dividend tax credit. That larger tax credit reduces the shareholder's personal tax. The second corporation is a Canadian-controlled private corporation that qualifies for the small business deduction. It pays corporate tax at a lower rate. Since less tax was paid at the corporate level, the shareholder receives a non-eligible dividend, which provides a smaller dividend tax credit. As a result, the shareholder pays somewhat more personal tax. Although the corporate tax and personal tax are different in these two situations, the Canadian tax system is designed so that the combined tax burden is approximately the same. In other words, when corporate tax is higher, personal tax is lower. When corporate tax is lower, personal tax is higher. The two levels of tax work together to produce a balanced overall result. This balancing effect is the essence of tax integration. Rather than focusing only on the corporate tax or only on the shareholder's personal tax, Canadian tax law considers the total tax paid by both the corporation and the shareholder together. The key takeaway is that eligible and non-eligible dividends exist to support tax integration. They are not intended to give one shareholder an advantage over another. Instead, they adjust the shareholder's dividend tax credit based on the amount of corporate tax that has already been paid, helping ensure that the combined corporate and personal tax is approximately the same regardless of the corporation's tax rate. Let's make this concept more concrete by comparing two corporations that earn exactly the same business profit, but pay different amounts of corporate tax. This example illustrates why the Canadian tax system uses eligible and non-eligible dividends, and how tax integration works in practice. Imagine that Corporation A and Corporation B each earn $100 of business profit. Even though both corporations earn the same amount, they are taxed differently. Corporation A pays tax at the higher general corporate tax rate. After paying corporate tax, it has less after-tax profit available to distribute. When it pays that profit to its shareholder, it is generally designated as an eligible dividend. Because the corporation has already paid more corporate tax, the shareholder receives a larger dividend tax credit, which reduces the amount of personal tax they pay. Now consider Corporation B. It also starts with the same $100 of business profit, but because it qualifies for the small business deduction, it pays tax at a lower corporate tax rate. As a result, it has more after-tax profit available to distribute. However, when that profit is paid to the shareholder, it is generally classified as a non-eligible dividend. Since less corporate tax was paid initially, the shareholder receives a smaller dividend tax credit, resulting in higher personal tax. At first, these two situations appear very different. One corporation pays more corporate tax, and less personal tax, while the other pays less corporate tax and more personal tax. But when we add the two levels of tax together, something interesting happens. The combined corporate tax and personal tax are intended to be approximately the same. This is the central idea behind tax integration. The Canadian tax system does not focus only on corporate tax or only on personal tax. Instead, it looks at the total tax collected across both levels. If corporate tax decreases, personal tax generally increases. If corporate tax increases, personal tax generally decreases. The dividend tax credit acts as the balancing mechanism that helps achieve this result. Keep in mind that the dollar amounts shown in this example are illustrative. Actual corporate tax rates, gross-up percentages, and dividend tax credits vary depending on the province, the taxation year, and the specific circumstances of the corporation and shareholder. The purpose of this example is to demonstrate the overall concept rather than calculate the exact tax payable. The key takeaway is that tax integration is about balancing the total tax burden. Eligible dividends and non-eligible dividends are simply tools that help adjust the shareholder's personal tax based on the amount of corporate tax already paid, so that the combined tax remains reasonably consistent regardless of which corporate tax rate originally applied. This example brings together everything we've learned about eligible dividends, non-eligible dividends, and tax integration. The most important idea to remember is that Canada's tax system is designed to balance corporate tax and personal tax so that the total amount of tax paid is approximately the same, regardless of how the corporation was taxed. Let's follow the eligible dividend path first. A corporation earns business income and pays tax at the higher general corporate tax rate. Since more tax has already been paid by the corporation, the shareholder receives an eligible dividend, which qualifies for a larger dividend tax credit. That larger tax credit reduces the shareholder's personal tax. In this situation, the corporation pays more tax, but the shareholder pays less. Now look at the non-eligible dividend path. Here, the corporation qualifies for the small business deduction and pays tax at a lower corporate rate. Because the corporation has paid less tax, the shareholder receives a non-eligible dividend, which provides a smaller dividend tax credit. As a result, the shareholder pays more personal tax than they would on an eligible dividend. In this case, the corporation pays less tax, but the shareholder pays more. Although these two paths seem different, they are actually working toward the same destination. The dividend tax credit adjusts the shareholder's tax to reflect the amount of tax already paid by the corporation. When corporate tax is high, the dividend tax credit is larger and personal tax is lower. When corporate tax is low, the dividend tax credit is smaller and personal tax is higher. This is the heart of tax integration. The Canadian tax system doesn't look at corporate tax or personal tax in isolation. Instead, it looks at the combined tax paid by both the corporation and the shareholder. The objective is that the total tax burden should be reasonably similar, whether the income was earned through a large corporation paying the general corporate tax rate or through a Canadian-controlled private corporation benefiting from the small business deduction. Of course, tax integration is not always perfect. Actual results can vary because of provincial tax rates, changes in tax legislation, and differences in individual circumstances. However, the overall design of the system is intended to keep the combined tax burden as balanced as possible. The key takeaway from this entire topic is that eligible and non-eligible dividends are not simply two different types of dividends. They are tools that support tax integration. Eligible dividends generally arise when more corporate tax has already been paid, resulting in a larger dividend tax credit and lower personal tax. Non-eligible dividends arise when less corporate tax has been paid, resulting in a smaller dividend tax credit and higher personal tax. Together, these rules help ensure that the total tax paid on corporate income remains approximately the same, regardless of the corporate tax rate that applied in the first place.